So Netflix's 2.2 million global net paid subscribers for Q3, that was about half of your estimate. Where's the disconnect?
I mean, the quarterly subscribers are extremely volatile. You really have to look at Netflix more on an annual basis in terms of subs, and they did only miss their guidance by 300,000 subscribers. I mean, the challenge that Netflix has at the moment is that they did almost a full year in the first half. The company added 26 million subscribers in the first half relative to 28 in the prior 2 years. And so they're dealing with the consequence, I think, of the after effects of the benefits of COVID. But going forward, this company is still on a run rate to kind of do 25 to 30 million subscriber additions a year in the future after this little bumpy period they're going through right now.
Right. So to your point, do you think that the numbers for Q3 is largely a result of this pull forward that they saw in the first half of the year, or is it emblematic of a slowdown and the fact that they have this user base that's largely penetrated at this point?
It's a little of both. I mean, you have the fact that it's a very large company now. The company is going to exceed 200 million global subscribers at the end of this year, and so it's not the Netflix of old, the 50 bagger over the past decade post the Quickster debacle. But it's a very large company, and it's a blue chip company now. It's transitioning to steady top line growth, 20–25%, depending on price increases, with expanding operating margins and free cash flow generation. That's a different narrative than the Netflix of old, but it's still a quite positive one. And, while we have a hold rating on the stock, we're pretty constructive on it overall.
Yeah, but I wonder, is that a narrative that then argues for a lower multiple over time, Scott? I mean, again, nobody's arguing. Incredible success. Yeah. We almost describe it as TV now, but it doesn't necessarily mean if it's entering a period of slower growth that people aren't going to be willing to pay less for it.
I agree. I mean, I think it becomes more predictable from here. There's not any noticeable kind of optionality on the platform that one could conclude at the moment relative to other peers that are at similar points in their life cycle, say like an Alphabet. But so you have to be more valuation sensitive. I think the dream in terms of the upside to subscriber numbers, that's something that played out over the past 10 years. The next 10 years is going to be this steady growth, expanding margin story, which is going to lead to some multiple compression, which has already begun. But you're paying about 55 times forward earnings for a 20 to 25% grower with expanding operating margins. It's not ridiculously valued, but I wouldn't argue it's cheap yet either.
Hey, Scott, social media remains under a lot of pressure regarding content moderation and perceptions of political bias. Evan's been pretty vocal about at least the president, and Snap no longer promotes his snaps. But how have they managed to fly under the radar on that front, and how long can that last?
Well, John Egbert on our team formally covers the social media stocks, but I could comment at a high level, which is that Snap is a closed community, relative to some of the other social networks, so is much less prominent in these discussions. So I think that when you're talking about some of the issues that social media faces, it's more really a Facebook and Twitter issue. Snap isn't really part of that debate.
Shepard Smith here. Thanks for watching CNBC on YouTube.